Before we begin, a quick but important disclaimer. I am not a licensed financial advisor, mortgage broker, or attorney. The information provided in this presentation is for educational and informational purposes only and should not be considered financial, legal, or tax advice. Buying a home is one of the biggest financial decisions you will ever make. So please consult with qualified professionals before making any decisions based on this content. You're sitting at a long, polished table. The air smells like fresh paper and stale coffee. In front of you is a stack of documents thicker than the last novel you tried to read. The person across from you, the closing agent, slides one particular document forward. It's called the closing disclosure. And it's a sea of numbers. Line after line of fees you've never heard of. Origination charge. Services you cannot shop for. Services you can shop for. Title lenders, title insurance. Government recording charges. Your eyes start to glaze over. You feel a knot forming in your stomach. Is this right? Am I being overcharged? You look at the person next to you, maybe your spouse, maybe your real estate agent. They just give you a polite, reassuring smile. The pen is in your hand, and in that moment you feel completely powerless. You just sign where they tell you to sign, hoping, praying that you aren't making a $1,000 mistake. If that scenario sounds familiar, or if it's the exact nightmare you're trying to avoid, you are in the right place. Because that feeling of confusion and powerlessness is not an accident. It's a feature of the system. The mortgage industry is built on complexity, and that complexity is incredibly profitable for the people who understand it, and incredibly expensive for the people who don't. But that ends for you right now. This isn't just another video defining a list of fees. This is your playbook. This is your secret weapon. Over the next several parts, we are going to systematically dismantle every single line item you will ever see on a loan estimate or closing disclosure. We're going to turn that confusing sea of numbers into a simple, actionable checklist. You will learn how to spot bogus junk fees from a mile away. You will learn which fees are negotiable and exactly how to negotiate them. And you will learn how to walk into your closing with the unshakable confidence that comes from knowing you are in complete control of the process, saving yourself potentially thousands of dollars. So let's get into it. When you look at all those closing costs, they can feel like a random, chaotic list. But they actually fall into three distinct buckets. Think of it like this. Bucket number 1, lender fees. This is the money you pay directly to the bank or mortgage company for the service of actually creating your loan. Bucket number 2, third-party fees. This is money you pay to other companies for required services like the appraiser, the title company, and the credit reporting agencies. The lender just passes these costs along to you. And bucket number 3, prepaids and escrow. This isn't really a fee at all. It's your own money that you have to pay up front for things like property taxes and homeowners insurance. Understanding these three buckets is the first major step to taking control, because it tells you who you need to talk to and where you have leverage. Today we're focusing on the first and most important bucket, the lender fees. This is the bank's profit center. This is where they make their money directly from you. And it's where you have the most direct power to question and negotiate. The mothership of all lender fees is the origination charge. You will see this on every single loan estimate. But what is it? Simply put, it's the lender's fee for the work of creating, processing, and funding your mortgage. Think of it as their main paycheck for doing the deal. This fee covers their overhead, the loan officer's commissions, the underwriter's salaries, the office electricity, all of it. This is almost always calculated as a percentage of the total loan amount. A common origination charge is between 0.5% and 1% of the loan. Now that might not sound like much, 1%, but let's run the numbers. If you're getting a $400,000 mortgage, a 1% origination fee is $4,000. That's a huge chunk of cash. And here's the secret. This fee is often negotiable. Lenders compete for your business. If you have a strong credit score and a solid financial profile, you are a desirable customer. You can and should get quotes from multiple lenders and use a lower origination charge from one lender as leverage to get another to match or beat it. Never just accept the first number you see. Now, sometimes instead of one big origination charge, lenders will break it down into a bunch of smaller, more official-sounding fees. This is a tactic called unbundling, and you have to watch for it. You might see things like an application fee, a processing fee, and an underwriting fee. Let's break those down. An application fee is a fee some lenders charge just to take your application. In today's competitive market, this is becoming less common. If you see it, you should question it. Many top-tier lenders don't charge this at all. And if they do, ask if it will be credited back to you at closing. If not, it might be a red flag that you're dealing with a higher cost lender. Next, the underwriting fee. This one is almost always legitimate. The underwriter is the financial detective for the lender. They are the person who meticulously goes through your bank statements, your pay stubs, your tax returns, and every other piece of your financial life to verify that you are a good risk. They are the final gatekeeper who gives your loan the green light. This is a highly skilled, critical job, and lenders pay underwriters a salary. So they pass that cost on to you. An underwriting fee is standard. You can expect this to be anywhere from $500 to $1,200, depending on the lender and the complexity of your file. While the fee itself isn't very negotiable, comparing this fee between different lenders is a smart move. Then there's the processing fee. The loan processor is the coordinator. They're the person who gathers all your documents, orders the appraisal, communicates with the title company, and basically shepherds your file from application to the underwriter's desk. It's an important administrative role. Now, some lenders will charge a separate processing fee, maybe $300 to $900. Others will bundle this cost into their main origination charge. This is a key area to watch. If a lender is charging you a full 1% origination fee, and a separate $900 processing fee, and a $1,200 underwriting fee, their total lender fees are getting very high. This is where you can push back and say, your competitor is bundling these costs. Why are you charging for them separately? Sometimes just asking the question can get the fee reduced or waived. Now we come to the most misunderstood, yet most powerful fee you can pay to a lender: discount points. This is a game changer if you understand it. Discount points are essentially prepaid interest. You are paying a lump sum of cash upfront at closing in exchange for the lender giving you a lower interest rate for the entire life of your loan. 1 point costs 1% of your total loan amount. So, on that same $400,000 loan, 1 point would cost you $4,000. Why on earth would you pay an extra $4,000 at closing? Let's do the math. Let's say the lender offers you a choice. You can have a 7% interest rate with 0 points. Or you can pay 1 point, that's $4,000, and get a 6.5% interest rate. On the 7% loan, your monthly principal and interest payment would be roughly $2,661. On the 6.5% loan, your payment would be about $2,528. That's a savings of $133 per month. Now, here is the most critical calculation you need to do. It's called the break-even point. You paid $4,000 upfront to save $133 a month. So, you take the cost for $1,000 and divide it by the monthly savings, $133. The result is about 30. That means it will take you 30 months or 2.5 years just to earn back the money you paid for the point. If you know with 100% certainty that you will be in that house and in that loan for the next 10, 15, or 30 years, paying for points can be an incredible financial move. You'll save tens of thousands of dollars in interest over the life of the loan. But if you think you might move or refinance in the next 3 or 4 years, paying for points could be a total waste of money. You'd move before you even hit your break-even point. Understanding your personal timeline is the key to deciding if discount points are a brilliant investment or a costly mistake. Finally, in the lender fee bucket, you might see a rate lock fee. When you get a mortgage, interest rates are fluctuating every single day. A rate lock is an agreement from the lender to guarantee you a specific interest rate for a set period, usually 30, 45, or 60 days, while your loan is being processed. This protects you from rates suddenly spiking right before you close. Most lenders will offer a standard 30 or 45-day lock for free. The cost is baked into their other fees. However, if you need a longer lock, say 90 days or more because you're buying new construction, they will almost certainly charge you a fee for that extended guarantee. This fee can be a flat fee or a percentage of the loan. It's a legitimate cost for a valuable service, but you should always ask if it's necessary for your timeline. So, to recap the lender fees, you have the main origination charge, which can be broken down into underwriting and processing fees. You have optional discount points to lower your rate, and you might have a rate lock fee for an extended lock. This is the lender's direct profit. This is where comparison shopping matters most. Every dollar you save here is a dollar straight back into your pocket. Always get at least 3 loan estimates from 3 different lenders and compare this section. Section A on the form, line by line. Question everything that seems redundant or vague. Ask, what is this for? And is this negotiable? Now you have a solid grasp on the fees your lender charges you directly. But that's only 1/3 of the story. The next big category of costs are the third-party services, the army of people the lender requires you to hire and pay for to get the deal done. This is where the costs can really add up, and where knowing your rights can save you a fortune. We're talking about the appraisal, the credit report, the title search, the flood certification, and more. And that's exactly what we're going to break down next. Let's start with one of the biggest and most familiar third-party fees, the appraisal fee. This is the fee you pay for a licensed, professional appraiser to determine the fair market value of the home you want to buy. You'll typically see this run anywhere from $300 to $600, sometimes more for a very large or unique property. Now you might be thinking, wait, why do I have to pay for this? Isn't it the bank's job to know what the house is worth? And that's exactly the point. The bank is lending you hundreds of thousands of dollars, and the house itself is the collateral for that massive loan. If for some reason you stop making payments, the bank needs to know that they can sell the house and get their money back. The appraisal is their insurance policy. It's an independent, unbiased opinion that confirms the property is actually worth the price you've agreed to pay. A very common point of confusion is the difference between an appraisal and a home inspection. This is critical. They are not the same thing. The home inspector works for you. You hire them to crawl through the attic, check the foundation, test the plumbing, and find every potential problem with the house so you can make an informed decision. The appraiser, on the other hand, works for the lender. While they'll note any obvious major issues that affect value, like a crumbling roof, their primary job isn't to find leaky faucets. Their job is to look at the property's size, condition, features, and location, and compare it to similar homes that have recently sold in the area. What are known as comps? Based on these comps, they arrive at a final valuation. If that valuation comes in at or above your offer price, everything is great. But if the appraisal comes in low, it can create a major problem, because the bank will only lend you an amount based on the appraised value, not the price you agreed to pay. It's a crucial step, and while you pay for it, it's really for the lender's peace of mind. Here's a key tip. Under federal law, you have the right to receive a copy of the appraisal report. Make sure you get it and review it. It's a valuable piece of information about your potential new home. Next up is a much smaller fee, but one that's absolutely non-negotiable. The credit report fee. This usually costs between $25 and $75. It's exactly what it sounds like. The lender needs to pull your detailed credit history and credit score from the three major bureaus, Equifax, Experian, and TransUnion. They use this report to assess your track record as a borrower. Do you pay your bills on time? How much debt are you carrying? Have you ever defaulted on a loan? Your credit score is one of the single most important factors in determining not only if you get approved for the loan, but more importantly, what interest rate you'll receive. A higher score means you're seen as less of a risk, which translates to a lower interest rate, potentially saving you tens of thousands of dollars over the life of the loan. There isn't much you can do about this fee itself, but the pro move is to get ahead of it. You are entitled to a free copy of your credit report from all three bureaus once a year through the official government-mandated website. Before you even talk to a lender, pull your reports, check them for any errors, a mistaken late payment, an account that isn't yours, and dispute them immediately. Cleaning up your credit before the lender pulls. It can have a massive impact on your financial future. Okay, let's move on to the heavyweight champion of third-party fees, the one that is often the most confusing and one of the most expensive, title services. This is a bundle of fees that can easily run over $1,000, sometimes much more. It includes things like a title search and, more importantly, title insurance. To understand this, you first have to understand what a title is. It's not a physical document, like the title to your car. In real estate, the title is a legal concept. It's your legal right to own, use, and sell your property free and clear of anyone else's claims. The problem is, a property's history can be long and messy. So before the lender gives you the loan, they require a title search. A title company sends a professional, a real-life property detective, to dig through decades of public records, deeds, mortgages, wills, divorce decrees, tax records, and court judgments. They are searching for any defects or clouds on the title. What are they looking for? They're looking for things like an unpaid property tax bill from a previous owner, which could have resulted in a lien against the house. They're looking for a contractor who was never paid for a new kitchen 5 years ago and filed a mechanic's lien. They're looking for an unresolved claim from a long-lost heir in a complicated inheritance, or a boundary dispute with a neighbor that was never legally settled. Imagine this nightmare scenario. You buy your dream home, you move in, you start your life, and 6 months later you get a knock on the door. It's a representative for the ex-spouse of the person who owned the home 2 owners ago, claiming that due to an error in their divorce decree, they still have a legal ownership stake in the property. Without a clear title, this person could legally have a claim to your house. This is what a title search is designed to prevent. But what if the title search specialist misses something? People make mistakes. Records can be forged, filed incorrectly, or an unknown heir could exist that no public record could ever reveal. That's where title insurance comes in. It's a unique type of insurance. Unlike car or health insurance that protects you against future events, title insurance protects you against things that have already happened in the past, but haven't been discovered yet. Now, this is the most important part to understand. There are 2 different kinds of title insurance. First, there's the lender's title insurance policy. This policy protects only the lender. It guarantees that the bank has a valid, enforceable lien on the property. If a title issue pops up later, the insurance company will pay the lender for their financial loss. Because it protects their investment, the lender will almost always require you to buy this policy for them. It is not optional. Second, there is the owner's title insurance policy. This policy protects you, the homeowner. It protects your equity in the property. If that same title claim arises, the owner's policy is what pays for your legal fees to defend your ownership and covers any financial loss you might suffer if the claim is valid, all the way up to the full value of the home. Here's the catch. The owner's policy is technically optional, but skipping it is one of the riskiest financial decisions a homebuyer can make. The lender's policy does absolutely nothing to protect your down payment or the equity you build over years of making payments. It's a one-time fee paid at closing that protects you for as long as you or your heirs own the property. My advice? Always get the owner's policy. And here's a tip most people don't know. You can and should shop around for your title insurance. Your lender or real estate agent might recommend a company, but you are not required to use them. A few phone calls to different title companies in your area could save you hundreds of dollars on this single fee. Finally, there's a small but significant fee called the flood certification fee. This is usually just $15 or $20. It's a fee paid to a third party to officially determine whether your property is located in a federally designated flood zone, according to the official FEMA flood maps. It's a simple yes or no. If the answer is no, you don't have to worry about it. But if the answer is yes, it triggers a mandatory requirement. You will be legally required by your lender to purchase separate flood insurance. This isn't covered by standard homeowners insurance, and it can be a very significant annual expense. So this tiny $20 fee can be the gateway to a much larger, ongoing cost you need to budget for. So we've covered the outside experts, the appraiser valuing the home, the credit agency assessing your risk, the title company protecting ownership, and the certifier checking for flood risk. These are all costs for services rendered by third parties. But what about the fees the bank charges for itself just for the privilege of giving you the loan? This is where the numbers get big and where the jargon gets confusing. We're talking about origination fees, processing fees, underwriting fees, and the mysterious world of discount points. This is where a little knowledge and negotiation can go a very, very long way. And that's what we're digging into next. Alright, let's pull back the curtain on these lender fees. Think of this category as the lender's paycheck. This is the money they charge for the service of creating, approving, and funding your massive loan. It's their business model, and understanding it is your first line of defense against overpaying. The headliner, the big one you'll always see, is the origination fee. If the mortgage process were a movie, this fee gets top billing. So what is it? Simply put, it's the lender's commission for doing the deal. It covers their operational costs, paying the loan officers, keeping the lights on, marketing, and of course their profit. Most of the time, this fee is expressed as a percentage of the total loan amount, usually somewhere between 0.5% and 1%. Let's make that real. On a $400,000 loan, a 1% origination fee is $4,000. A 0.5% fee is $2,000. That's a $2,000 difference for the exact same house and the exact same loan amount, just from a different lender. This isn't pocket change. This is a plane ticket, a new laptop, a significant chunk of your moving expenses. And here's the most important thing you need to know about the origination fee. It is almost always negotiable. Lenders are in a competitive business. They want you. When you get a loan estimate from lender A that has a 1% origination fee, and another from lender B that has a 0.5% fee, you have leverage. You can go back to lender A and say, hey, I'd love to work with you, but your competitor is offering me a loan with a much lower origination fee. Can you match that? More often than you think, they will. They might not erase it completely, but they might come down significantly. They'd rather make less profit on your loan than no profit at all. Never, ever just accept the first origination fee you see as a fixed, non-negotiable cost. It's not. It's the starting point of a conversation. Now, swimming in the same pool as the origination fee are two other common charges: the processing fee and the underwriting fee. Sometimes these are bundled into the origination fee, and sometimes they're listed as separate line items. It's crucial to look for them. Let's define our terms. The loan processor is like the project manager for your mortgage application. They are the person gathering all your documents, your pay stubs, your bank statements, your tax returns, that letter explaining why you had a late payment on a credit card 5 years ago. They wrangle the paperwork, check for completeness, and package it all up neatly for the next person in line. The processing fee, which can be anywhere from $300 to $900, pays for their time and effort. That next person in line is the underwriter. The underwriter is the risk detective. They are the final decision maker. They don't know you, they don't care about your story. They are paid to look at your file with a cold, objective eye and determine one thing. Are you a good bet? Will you pay this loan back? They meticulously go through the package the processor prepared, verify your income, analyze your debt, scrutinize your credit history, and check that the property itself meets the lender's guidelines. The underwriting fee, often between $400 and $1,000, is what you pay for that expert judgment, that final stamp of approval or denial. So, are these fees negotiable? The answer is sometimes, but it's trickier. Unlike the origination fee, which is largely profit, processing and underwriting fees are often tied to the actual cost of labor for the lender. It's harder for them to waive a fee that pays a specific employee's salary. However, that doesn't mean you can't question it. If one lender is charging you $900 for underwriting and another is charging $500, that's a red flag. It's another point of leverage. You can ask them to explain the difference, and you can certainly ask if they can reduce it to be more competitive. The key is to compare. Always compare. Okay, now for the most misunderstood charge of them all, discount points. This one is a shapeshifter. It looks like a fee, it's paid like a fee, but it's not really a fee in the same way. It's a choice. Discount points are, in essence, prepaid interest. You are paying a lump sum of cash upfront at closing, in exchange for the lender giving you a lower interest rate for the entire life of the loan. 1 point typically costs 1% of your total loan amount. Let's walk through an example because this is where people get lost. Imagine you're getting that same $400,000 loan. The lender gives you two options. Option A, a 7% interest rate with 0 points. Your monthly principal and interest payment would be roughly $2,660. Option B, they offer you a 6.75% interest rate, but it will cost you 1 discount point. Remember, 1 point equals 1% of the loan amount. So on a $400,000 loan, 1 point costs you $4,000 paid at closing. For that $4,000, your new monthly payment at 6.75% would be about $2,593. You're saving $67 every single month. Sounds good, right? But here's the critical question you have to ask. When do I break even? You just spent $4,000 to save $67 a month. To figure out your break-even point, you divide the cost of the point by your monthly savings. So, $4,000 divided by $67 is about 59.7. Let's call it 60 months. That's 5 years. It will take you 5 full years of making that lower mortgage payment just to earn back the $4,000 you paid up front. If you know with absolute certainty that you're going to be in this house for 10, 15, or 30 years, then paying for points might be a fantastic financial decision. You'll save thousands, even tens of thousands of dollars in interest over the long haul. But what if you think you might move in 4 years? Or refinance? If you sell that house before you hit the 5-year break-even point, you've actually lost money on the deal. You gave the bank $4,000 and didn't stick around long enough to reap the full benefit of the monthly savings. So, paying for points isn't inherently good or bad. It's a strategic decision based entirely on your personal timeline. Don't let a loan officer push you into it just because the lower rate looks attractive on paper. Do the break-even math for yourself. It's simple division that could save you thousands. So these are the core lender charges: origination, the profit; processing and underwriting, the labor; and discount points, the optional rate buy down. This is the first major category of costs you'll see on your loan estimate. But here's the thing. They're not even half the story. The lender's fees are just the beginning. The next mountain to climb is the enormous list of third-party fees. These are costs for services performed by other companies that the lender requires you to pay for as a condition of getting the loan. This is where the list gets long, and where a lot of unexpected costs can hide in plain sight. We're talking about appraisal fees, credit report fees, flood certification, title insurance, and that's just scratching the surface. This next category is where you need a magnifying glass and a healthy dose of skepticism. Let's call this next group the lender's cut. These are the fees the bank or mortgage company charges you for the privilege of doing business with them. They're not paying a third party for a specific service like an appraisal. They're paying themselves. This is where the lines get blurry and the names get creative. You'll see things like processing fee, underwriting fee, admin fee, or application fee. To the average person, these all sound like the same thing, the cost of doing the loan. And in a way, you're right. Think of it like this: you go to a fancy restaurant. You order a steak for $50. You expect that price to cover the cost of the chef cooking it, the server bringing it to you, and the lights staying on in the building. But what if when the bill came, there was a separate $10 chef fee, a $5 service fee, and a $3 electricity usage fee? You'd feel a little ripped off, right? You'd think, shouldn't that just be part of the price of the steak? Welcome to the world of mortgage origination charges. Let's break down the big ones. First up, the underwriting fee. This is probably the most legitimate sounding fee in the bunch, and for good reason. The underwriter is the financial detective, the final boss of your loan application. This is the person, or increasingly the sophisticated algorithm, that goes through your entire financial life with a fine-tooth comb. They verify your income, your assets, your debt, your credit history, the property's value, everything. They are the one who gives the final thumbs up or thumbs down. Their job is to protect the lender from making a bad loan. So the underwriting fee, which can range from $400 to over $1,000, pays for that expert analysis. It's a critical part of the process. But here's the secret. While the process is non-negotiable, the fee sometimes is. It's a direct cost to the lender, but it's also a profit center. If you are a very strong borrower, high credit score, low debt-to-income ratio, large down payment, you have leverage. The lender wants your business, and they might be willing to reduce or even waive this fee to get it. Next to it on your loan estimate, you'll often find the processing fee. This can feel like a double dip. If the underwriter is the detective, the processor is the case manager. They're the ones gathering all your documents, your pay stubs, your bank statements, your tax returns, and packaging them up neatly for the underwriter. They chase down paperwork, coordinate with the title company, and make sure all the I's are dotted and T's are crossed before it gets to the final boss. So, you're paying for the administrative work. Again, it's a necessary job. But the fee, typically a few $100s, is another one of those internal lender charges. It's another line item that can be a point of negotiation. Some lenders bundle this with the underwriting fee into a single origination fee, while others list them separately to make each individual charge seem smaller. Don't be fooled. You have to look at the total of all lender fees. This brings us to the fees that should raise your eyebrows the highest. These are the ones with vague, all-encompassing names. The administrative fee, the document preparation fee, the application fee. Let's be honest, in an age where you can apply for a loan on your phone in 10 minutes, a $500 application fee can feel insulting. And a document preparation fee? They're charging you hundreds of dollars to press print on a set of standardized legal forms? Well, yes and no. The lender's argument is that these fees cover their overhead, the cost of software, legal compliance, office space, and the general cost of doing business. For document preparation, they'll argue that ensuring every single page of a massive loan package is accurate and compliant with a web of federal, state, and local laws is a high-stakes task that carries significant liability. One mistake on a document could invalidate the entire loan. But let's be real. These are often the softest fees on the page. They are the easiest for a lender to adjust without changing the fundamental economics of your loan. They are pure profit and overhead. This is your prime negotiating territory. When you get loan estimates from 3 different lenders, and you absolutely should, this is the section you need to compare with a laser focus. Let's imagine our home buyer. We'll call her Chloe. Chloe is a first-time buyer, and she's diligent. She applies with lender A, lender B, and lender C. The loan estimates come back. Lender A has a great interest rate, but when Chloe looks at the origination charges, she sees a $950 underwriting fee and a $500 processing fee. Total, $1,450. Lender B has a slightly higher interest rate, but their sheet only shows a single $1,000 origination fee. Lender C has a similar rate to Lender A, but they have no processing fee and only an $800 underwriting fee, but they've added a mysterious $400 admin fee. It's an alphabet soup of charges. So what does Chloe do? She doesn't just look at the interest rate. She doesn't just look at the monthly payment. She takes out a calculator. She sees that Lender A and Lender C are charging her roughly the same amount in total fees, around $1,400, while Lender B is cheaper at $1,000. Now she has power. She can go back to Lender A, the one with the best interest rate, and say, I really want to work with you and your rate is the most competitive. However, I have an offer from Lender B, and their total origination charges are $450 less than yours. Can you match that? Notice she didn't say, can you waive the processing fee? She spoke in terms of the total bottom line impact. This is a much more powerful position. The loan officer doesn't want to lose a deal over a few $100s they have control over. They might say no, but they might also say, okay, we can't eliminate the processing fee entirely, but we can issue a lender credit for $400 to offset it. Boom! Chloe just saved herself $400 with one 5-minute phone call, simply by understanding that these fees are not set in stone. This is the game within the game. The interest rate is the headline, but the fees are the fine print where lenders make a significant amount of their profit. They know that most buyers are so focused on the rate and the dizzying process of buying a home that they'll just gloss over these charges. They're counting on you to be too overwhelmed or too timid to question them. Don't be. The key takeaway here is to treat the sum of all these lender-specific fees, the processing, underwriting, admin, doc prep, whatever they decide to call them, as one single number. That number is the lender's price tag for originating your loan. And just like any price tag, it is often negotiable. Get multiple offers. Compare that total number. And use a competing offer as leverage to get the best possible deal. Don't get distracted by the individual names they use. Focus on the total cost to you. By mastering this one section of your loan estimate, you're moving from being a passive participant to an active, empowered negotiator. You're not just accepting the first offer that comes your way. You're shaping the deal in your favor. But these lender fees are only one piece of the puzzle. There's another, even more complex category of charges that you have some control over, but in a very different way. These are the third-party services that the lender requires, but doesn't provide themselves. And this is where you can start shopping around to find major savings if you know where to look. And the first place we're going to look is one of the most mysterious and expensive items on your closing statement: title services. This single-line item can easily run into the thousands of dollars, and most homebuyers just nod and pay it, assuming it's a fixed, non-negotiable cost. It's not. This is your first major opportunity to flex your consumer muscles and potentially save a huge chunk of change. So what on earth is title anyway? Think of it like a background check for your house. Before you buy a car, you might get a Carfax report to see its history, accidents, previous owners, any red flags. A title search does the same thing for a property. It scours public records to uncover the property's entire life story. Who owned it before? Are there any old, unpaid mortgages still attached to it? Did a contractor file a lien against the property because they never got paid for a kitchen remodel 10 years ago? Are there any surprise heirs from a will written in 1950 who might suddenly show up and claim the house is theirs? This process is absolutely critical. You need to know that when you buy the property, you are getting a clear title, meaning you are the sole rightful owner, free and clear of anyone else's claims from the past. The company that does this research is the title company, but their job doesn't stop there. After the search, they issue something called title insurance. Now, this is where most people get confused. Unlike car insurance or health insurance that protects you from future events, title insurance protects you from the past. It's a one-time premium you pay at closing that insures you against any mistakes or skeletons the title search might have missed. If that long-lost heir does show up with a valid claim to your new home, the title insurance policy is what protects you and your lender from financial ruin. It defends your ownership in court and covers any losses if the claim is valid. Now, on your loan estimate, you're going to see two different title insurance policies, and you need to understand the difference. The first is the lender's title insurance policy. This is mandatory. You have no choice. This policy protects only the lender. It guarantees that if you default on your loan and the bank has to foreclose, there are no other claims on the property that would prevent them from taking it over and selling it to get their money back. You pay the premium, but the policy protects the bank. The second policy is the owner's title insurance policy. In most states, this is technically optional, but I'm telling you right now, you should consider it absolutely essential. This is the policy that protects you, your down payment, your equity, your right to the property. Without it, if a title issue comes up after you've closed, you could be on the hook for tens or even hundreds of thousands of dollars in legal fees, or in a worst-case scenario, you could lose the house entirely and have no recourse. Skipping an owner's policy to save $1,000 is like refusing to wear a seatbelt to save a few seconds. The risk is catastrophic. So, where do the savings come in? You have the right to choose which title company or settlement agent handles your closing. Your lender or real estate agent will likely recommend their preferred partner, and for convenience, most people just go with it. Don't. This is where you shop. The insurance premiums themselves are often regulated by the state, so the price for the policy might be similar from one company to the next. However, the other fees the title company charges are not. They charge for the title search itself, for document preparation, and most importantly, for a settlement fee or closing fee for their services in conducting the closing. These ancillary fees can vary by hundreds of dollars between companies. Your move is to get the name of your lender's preferred title company, and then call 2 or 3 other reputable title companies in your area. Ask your real estate agent for recommendations, or do some research online for well-reviewed local options. Call them and say, "I'm buying a home for X price with Y loan amount, and I'm shopping for title services. Can you send me a quote for your fees, including the owner's and lender's policies, title search, and your settlement fee?" Comparing these quotes side by side is a simple 10-minute task that can easily save you $3, $4, even $500 or more. You are buying the exact same insurance policy, the exact same protection, but you're choosing a more affordable administrator. This same shop-around principle applies to several other third-party fees. Let's talk about the property survey. In some areas and for some loan types, a lender will require a survey to be performed. This is when a licensed surveyor comes out to your potential new home and creates an official map of the property. It confirms the legal boundaries, shows the exact location of the house, fences, and driveways, and identifies any easements or encroachments. Basically, it ensures that the little patch of earth you think you're buying is the little patch of earth you're actually buying, and that your neighbor's new garage isn't 2 feet on your side of the line. The cost for a survey can range from a few hundred to over $1,000, depending on the size and complexity of the lot. Again, the lender will have a list of approved surveyors, but you are not obligated to use the first one on the list, or the one your agent happens to call. You have the right to obtain your own quotes. Call several local licensed surveyors. Give them the property address and ask for a price. You might be shocked to find a $200 difference for the exact same service, performed to the exact same legal standards. Next up, the pest inspection, sometimes called a termite inspection or WDO, which stands for Wood Destroying Organism, report. Many lenders, especially for government-backed loans like VA and FHA, require a licensed professional to inspect the home for any signs of active or past infestations of things like termites, carpenter ants, or wood-boring beetles. These pests can cause devastating structural damage that is often hidden inside walls, and an inspection is a relatively cheap way to get peace of mind. Even if your lender doesn't require it, you should absolutely get one. The cost is usually pretty low, often between $75 and $150. And just like the survey, you can and should shop for this service. Your agent will have a go-to person, but you can find your own licensed pest inspector. A quick search and a few phone calls can ensure you're getting a fair price. While you might only save $20 or $30 here, it's about the principle. Every dollar you save at the closing table is a dollar in your pocket. When you add it all up, a few hundred on title and settlement fees, maybe $100 on the survey, $20 on the pest inspection, you're suddenly looking at a very real savings of $500 or more. That's a new washing machine. That's your first few months of utility payments. That's a significant amount of money you get to keep, simply by refusing to accept the default option and making a few phone calls. You are in control of these costs, and exercising that control is one of the smartest things you can do in the home buying process. We've now covered the fees for services you've already received, from the lender's work to the third-party reports. But there's another major category of closing costs that often confuses and surprises buyers, because it involves paying for things that haven't even happened yet. This is the world of prepaids and escrow accounts, where you pay up front for future expenses like property taxes and homeowners insurance. Understanding how this works is the absolute key to avoiding a massive cash-to-close shock and truly mastering your mortgage budget. So let's pull back the curtain on this concept of prepaids and escrow. because it's responsible for one of the biggest sticker shock moments a homebuyer can have. Imagine for a second that your mortgage payment is like a pizza. The biggest slice, the one everyone talks about, is your principal and interest. That's the part that actually pays down your loan. But there are two other, very important slices: property taxes and homeowners insurance. Together, these four pieces, principal, interest, taxes, and insurance, are often bundled together into one monthly payment, famously known as PITI. The lender does this for one simple, self-serving reason: to protect their investment. That house isn't technically yours until the loan is paid off. It's the bank's collateral. They have a massive financial stake in making sure it doesn't get seized by the county for unpaid taxes or burned to the ground without an insurance policy to rebuild it. So they don't trust you to save up and pay those huge bills on your own. Instead, they force you to pay a little bit toward them every single month. This forced savings account is called an escrow account, or sometimes an impound account. Every month when you make your PITI payment, the bank schemes the T and the I off the top and deposits them into this special account. Then when your property tax bill or your homeowner's insurance premium is due, the bank pays it for you on your behalf, using the money you've been saving in that account. It's actually quite convenient. It prevents you from having to come up with, say, $3,000 for a tax bill right after the holidays. But the confusion, the shock, comes from how this account is set up at the closing table. You can't just start with a zero balance. The lender needs a cushion. They need to make sure there's always enough cash in the account to pay the bills, even if the timing is awkward. By law, they're allowed to keep a buffer in your escrow account of up to 2 months' worth of escrow payments. This cushion is the key. Let's make this real. Meet Mark and Sarah, a fictional couple buying their first home for $400,000. Their annual property taxes are estimated to be $6,000, and their homeowner's insurance policy is $2,400 a year. Let's do the math. The annual property tax of $6,000 breaks down to $500 per month. The annual insurance of $2,400 breaks down to $200 per month. So the total monthly deposit into their escrow account will be $700. This is the T and I part of their PITI. Now remember that 2-month cushion the lender is allowed to keep? 2 months of $700 payments is a $1,400 cushion. The lender wants to ensure the balance in the escrow account never, ever drops below $1,400. This is where the timeline becomes absolutely critical. Let's say Mark and Sarah close on their house on June 15th. A weird rule of mortgages is that your first payment is typically due on the first of the month following the month after you close. So they close in June, skip July, and their very first mortgage payment isn't due until August 1st. But the lender's clock is already ticking. They know that a big semi-annual property tax bill of $3,000 is due in November. They have to make sure there's enough money in the escrow account by then to pay it. Let's track the money. Mark and Sarah close in mid-June. They have $0 in their escrow account. On August 1st, they make their first payment. The bank deposits $700 into escrow. The balance is now $700. On September 1st, they make their second payment. Another $700 goes in. The balance is now $1,400. On October 1st, a third payment. Balance is now $2,100. On November 1st, a fourth payment. Balance is now $2,800. A few weeks later, that $3,000 tax bill comes due. The lender needs to pay it. But wait, they only have $2,800 in the account. They're short by $200. And even if they did have enough, paying the bill would drain the account to zero, completely wiping out that required $1,400 cushion. This is the exact problem the lender solves at the closing table. They look ahead at the calendar and calculate the absolute minimum amount of cash they need from you on closing day to pre-fund the account, so that it never falls below the required cushion. In our example, the lender knows that by November, after paying the $3,000 tax bill, they need $1,400 left over. This means they need a grand total of $4,400 in the account by November. They also know that Mark and Sarah will have made 4 payments of $700 each, totaling $2,800 by then. So what's the difference? $4,400 minus $2,800 is $1,600. That $1,600 is the amount the lender will collect from Mark and Sarah at closing and deposit directly into the escrow account as seed money. This charge will appear on your closing disclosure, and it often shocks people. It can be thousands of dollars that you weren't expecting if you didn't understand how the math worked. You're essentially paying several months of future taxes and insurance upfront just to get the account started on the right foot. Now let's separate this from the term prepaids, because they are different, even though they live in the same section of your closing documents. Prepaids are exactly what they sound like. You are paying for certain items in advance. The escrow deposit is seed money for a savings account for bills due far in the future. Prepaids are for bills due right now. The number one prepaid item is your first full year of homeowner's insurance. Lenders will not give you the money for the house unless they know it's insured from the very second you own it. So they require you to pay the entire first year's premium at or before closing. For Mark and Sarah, that's a $2,400 check they have to write. This is a separate charge from the escrow setup. Remember, the escrow account is being funded to pay for the second year's policy, not the first. The other major prepaid item is prepaid interest. This one requires a little bit of focus. Your mortgage interest is paid in arrears, meaning you pay for the month that just passed, not the month ahead. When you make your August 1st payment, you are paying the interest that accrued during the month of July. But what about the period between your closing day and the end of that month? Mark and Sarah closed on June 15th. Their first payment on August 1st covers July's interest. But who pays the interest for the last 16 days of June, from June 15th to June 30th? You do. At the closing table. This is called prepaid interest. You are paying up front the daily interest on the loan for every day remaining in the month of closing. This is why many people try to close at the end of the month. If you close on June 29th, you only have to pay for 2 days of prepaid interest. If you close on June 2nd, you have to pay for 29 days of interest. It doesn't change the total amount you pay over the life of the loan, but it dramatically affects the amount of cash you need to bring to closing. So let's put it all together for Mark and Sarah. In this section of their closing costs, they have 3 major items. First, the prepaid homeowner's insurance premium for the first year, $2,400. Second, the prepaid daily interest from their closing date of June 15th to the end of the month. And third, the initial escrow deposit to seed the account for future bills, which we calculated to be $1,600. Suddenly, you're looking at over $4,000, plus the prepaid interest, in a category of fees that many first-time buyers have never even heard of. It's not a scam and it's not junk fees. It's simply the operational cost of managing the large, recurring bills associated with homeownership. It's the bank protecting its asset by creating a system you are forced to pay into. Understanding this math before you even get your closing statement is the difference between a smooth, predictable closing and a frantic, last-minute panic, trying to figure out where you're going to get an extra $5,000. But taxes and insurance, as complex as they are only part of the puzzle. There's another layer of protection, another category of fees, that deals with something far more fundamental: the legal right to own the property itself. This deals with the history of the home, its previous owners, and any hidden claims or liens that could come back to haunt you years after you've moved in. This is the world of title insurance and title search fees, a murky and often misunderstood cost that ensures the home you're buying is actually yours to buy. And getting this part wrong can have consequences far greater than a surprise bill. Let me tell you a story. It's about a young couple. Let's call them Mark and Jessica. They did everything right. They saved for years, got pre-approved, and found their perfect little bungalow in a quiet neighborhood. They went through the inspections, negotiated the price, and finally, they sat at the closing table, signing a mountain of paperwork. They were handed the keys. The feeling was electric. It was theirs. For 6 months it was paradise. They painted the rooms, planted a garden, and met the neighbors. Then, one Tuesday afternoon, a certified letter arrived. It was from an attorney representing a man they'd never heard of, a man who claimed he was the rightful heir to half of their property, citing a poorly probated will from a previous owner 2 decades ago. Suddenly, their dream home wasn't a sanctuary. It was a legal battlefield. Their entire life savings, their future, was now hanging in the balance, threatened by a ghost from the property's past. This nightmare scenario is precisely what title fees are designed to prevent. This isn't just paperwork. It's a shield. The first part of this shield is the title search. Think of it as a deep dive background check on the property itself. A title professional doesn't walk through the house looking for cracks in the foundation. They go to the county courthouse, digitally and physically, and become a historian. They are hunting for defects or clouds on the title. They meticulously trace the chain of ownership back for decades, ensuring every transfer was legal and legitimate. They're looking for monsters hiding in the public record. Monsters like outstanding liens. Maybe the previous owner never paid a contractor who remodeled the kitchen, and that contractor has a legal claim against the property. Or maybe there are unpaid property taxes or an old, unreleased mortgage from a prior owner that's still technically attached to the home. They also search for easements. This is a big one. An easement is a legal right for someone else to use a portion of your property for a specific purpose. You might find out that the utility company has a 10-foot easement running right through the spot where you plan to build a pool. Or your neighbor might have a legal right to use your driveway to access their garage. These are things you absolutely need to know before you buy. The title search uncovers these secrets, along with things like zoning restrictions or covenants that might prevent you from, say, parking an RV in your driveway or painting your house a certain color. Essentially, the title search fee pays for the expert time and resources to create a comprehensive history report of the property's legal status. The goal is to find and resolve any of these issues before you close. The seller might have to pay off an old lien, or a legal document might need to be filed to clear up an error from a sale that happened in 1985. But here's the critical part. What if they miss something? No search is infallible. People are human. Documents can be misfiled, forged, or simply missing from the public record. An unknown heir, like in Mark and Jessica's story, could appear out of the blue with a legitimate claim that no amount of searching could have ever uncovered. This is where the second and arguably more important part of the shield comes in: title insurance. This is one of the most misunderstood costs in the entire home buying process, so lean in close. Unlike every other form of insurance you have, which protects you against future events, a future fire, a future car accident, title insurance protects you against past events. It protects you from the ghosts. It's a one-time premium you pay at closing that protects you from financial loss due to title defects that were missed in the title search. Now this is where it gets really important. There are not one but two types of title insurance policies, and you need to understand the difference. The first is the lender's title insurance policy. Your mortgage lender will require this. You, the buyer, will pay for it. But here's the catch. It doesn't protect you. It protects the lender. It guarantees that if a catastrophic title issue arises and you lose the house, the lender will get their loan money back. Their investment is safe. The cost of this policy is based on the loan amount, and it's non-negotiable if you're getting a mortgage. The second policy is the owner's title insurance policy. This one is for you. This is what protects your down payment, your equity, your home. If that long-lost heir comes knocking on your door, this policy is what pays for the attorneys to defend your claim to the property. It covers the court costs. And in a worst-case scenario where the claim is valid and you actually lose the home, the owner's policy will reimburse you for your financial loss, up to the full purchase price of the property. In most transactions, the owner's policy is presented as optional. But let me be perfectly clear, it is not. Not buying an owner's policy is like the lender wearing a bulletproof vest that they make you pay for, while you stand right next to them with no protection at all. It's financial insanity. The one-time fee, which might be $1,000 or $2,000 depending on the home's value and your state, protects your single largest asset for the entire time you and your heirs own that property. It is one of the single best investments you can make at the closing table. So how much does all this cost? The title search itself might be a few $100s. The insurance policies are the bigger ticket items, and their cost is regulated at the state level, often based on the home's purchase price. But here's a pro tip. You can and you should shop around. Your lender or real estate agent will likely recommend a preferred title company, but you are not obligated to use them. You can call a few different title companies and compare their fees. Sometimes the insurance premium itself is fixed by state law, but the ancillary fees like courier fees, document prep fees, can vary, and you can save a few $100s just by making a few phone calls. Here's another insider tip. Ask about a reissue rate or reissue credit. If the person you're buying the house from has an owner's title policy from when they bought the house, the title company doesn't have to search as far back in the records. Because of this reduced risk and work, they will often give you a significant discount on your new policy, sometimes as much as 40%. But you often have to ask for it. So, the title search is the investigation. The title insurance is the armor. Together, they ensure that the deed you receive at closing is clean, legitimate, and that your ownership is protected from claims that reach out from the grave. It's the cost of peace of mind, ensuring that when you get the keys to your new home, it is truly, legally, and indisputably yours. So, once you've proven the property is legally yours to buy, and you've insured it against the ghosts of its past, you think you're done paying people. But there's one entity that always gets its cut: the government. Next, we're diving into the world of recording fees and transfer taxes, the official costs of putting your name on that deed. And this is where the transaction stops being a private agreement between you, the seller, and the lender, and becomes an official, legally binding public fact. Recording fees and transfer taxes are the cost of etching your ownership into the stone tablets of your local government. Think of it like this: everything you've done up to this point, the application, the appraisal, the title search, has been about getting permission to buy the house. This next step is about announcing to the entire world that you did it. Let's start with the smaller of the two, the recording fee. This is exactly what it sounds like. It's the fee the county clerk's office, or the recorder of deeds, charges to officially record the sale in their public records. This is a profoundly important, yet often overlooked part of the process. When they record your deed in your mortgage documents, they are creating a permanent, searchable record that proves you are the new rightful owner. It's the government's way of rubber stamping your purchase and saying, "Yep, we see it. It happened. It's official." Why does this matter so much? Because this public record is your ultimate defense. It prevents the person who sold you the house from turning around tomorrow and trying to sell it to someone else. It establishes the chain of title, proving a clear line of ownership from the past owner to you. It also publicly registers your lender's lien on the property, which is why they insist on it. Without this official recording, legally speaking, the transaction is in a dangerous limbo. It's the difference between having a private IOU and having your money registered with the US Treasury. One is a promise, the other is a fact. So, how much does it cost to make history? Thankfully, recording fees are usually one of the more modest closing costs. You're typically looking at a range from $50 to maybe $250. The exact amount is determined by the local government and is often calculated based on the number of pages in the documents being filed. Your deed might be a few pages, your mortgage document could be dozens. They charge per page, so the thicker the paperwork, the higher the fee. It's a very straightforward, administrative cost. You're not paying for a service, you're paying for a filing cabinet, a very, very important permanent public filing cabinet. Now let's talk about its bigger, much more expensive, and far more controversial cousin, the transfer tax. If the recording fee is the cost of filing the paperwork, the transfer tax is the government's tax on the transaction itself. It's a tax levied on the transfer of property from one owner to another. And depending on where you live, this fee can be a gut punch. Unlike the flat, page-based recording fee, the transfer tax is almost always calculated as a percentage of the sale price. And this is where the numbers can get very big very fast. Goes by many names, which can be confusing. You might see it called a deed tax, a stamp tax, or a real estate conveyance tax. But whatever the name, the function is the same. The state, county, or even the city is taking a slice of the pie simply because the property changed hands within their jurisdiction. The cost of transfer taxes varies wildly across the United States. It is one of the most location-dependent fees you will encounter. Some states have no transfer tax at all. States like Texas, Indiana, and Mississippi, for example, won't charge you a dime at the state level. Congratulations to you if you're buying there. But then you have the other end of the spectrum. In a state like Pennsylvania, the state transfer tax is 1%, and then local municipalities can add their own, often bringing the total to 2% or more. On a $400,000 home, a 2% transfer tax is $8,000. That's not a typo. $8,000. In Delaware, the standard rate is 4%, often split between buyer and seller. That's $16,000 on that same home. Washington state has a progressive tax that can go up to 3%. Go to Washington, D.C., and a transfer tax can climb to nearly 1.5%. This is why you absolutely cannot rely on national averages for this fee. You have to know your local rules. And here's the next critical question. Who pays for it? The recording fee is almost always paid by the buyer, because you're the one who wants to record your new ownership. But the transfer tax? It's a total toss-up. In some areas, it's customary for the seller to pay the entire tax. In others, the buyer pays. In many places, like that Delaware example, it's common to split it 50-50. And here's a pro tip. While the tax itself is set by law and is non-negotiable with the government, who pays that tax is absolutely a point of negotiation in your purchase contract. If you're in a buyer's market, you might be able to negotiate for the seller to cover the entire transfer tax. If you're in a hot seller's market, good luck. You'll likely be expected to foot the bill. It's a major bargaining chip that can swing your closing costs by thousands of dollars. It's also worth investigating if you qualify for any exemptions. Some jurisdictions offer reduced rates or complete exemptions for first-time homebuyers, or for properties being transferred between immediate family members. Don't just assume you have to pay the sticker price. A little research or a question to your real estate agent could save you a significant amount of money. So when you see these line items on your closing disclosure, don't just roll your eyes at another government fee. Understand what you're paying for. The recording fee is your proof. It's your shield. It's the small price you pay to have the full weight of the public record behind your claim to your home. And the transfer tax, as painful as it might be, is the toll you pay to move that ownership from their name to yours on the official map. It's the final and most official expense of the transaction itself. You've paid the inspectors to vet the house, the appraisers to value it, the title company to clear it, and now the government to record it. It feels like every possible hand has been in your pocket. The house is officially, legally yours. But your journey of paying for things isn't quite over. In fact, you're about to start paying for expenses you haven't even incurred yet. We're moving from the one-time fees of closing the deal to the recurring costs of homeownership itself. And it all starts with something called prepaids and the fascinating, and often confusing, world of escrow. This is where the math starts to feel a little strange. Because you're not just paying for things that have already happened, you're now paying for things that haven't happened yet. This is the world of prepaids and escrow, and it's arguably one of the most misunderstood parts of a mortgage. But once you get it, your entire monthly payment will finally make sense. Let's start with the term prepaids. It's exactly what it sounds like. You are prepaying for certain housing expenses at the closing table. These aren't fees for the loan itself. They are your own expenses paid in advance. The two biggest players here are homeowners insurance and property taxes. First, homeowners insurance. Your lender will not give you a penny until you prove the house is insured against fire, theft, and other disasters. They have a massive financial stake in that property, and they need to know it's protected. So they require you to purchase a full year's worth of homeowners insurance, and you have to pay that entire first-year premium at or before closing. If your annual premium is, say, $1,800, you're paying that full amount right then and there. This is a prepaid item. You've paid for your first year of insurance before you've even spent a night in the house. The next prepaid item is a bit trickier. Prepaid interest. This one confuses everyone. You know that your first mortgage payment isn't due on the first of the next month, right? If you close on May 15th, your first payment isn't due on June 1st. It's usually due on July 1st. But why? It's because mortgage interest is paid in arrears, meaning you pay for the month that just passed, not the month ahead. Your July 1st payment covers the interest for the month of June. So what about the period from May 15th to May 31st? You owned the house, you had the loan, so interest was accruing. That's where prepaid interest comes in. At the closing table, you will pay the per diem, or daily, interest on your loan for the remaining days of the month in which you close. If you close on the 15th of a 31-day month, you'll pay for 17 days of interest. If you close on the 30th, you only pay for 2 days. This is why many people try to schedule their closing for the end of the month. It dramatically reduces the amount of cash they need to bring to the table for prepaid interest. It doesn't save you money in the long run, it just changes when you pay it. Now, these prepaids, the homeowner's insurance, the property taxes, and the interest, are the seed money for the main event, your escrow account. If you've ever heard the term escrow and imagined some mysterious vault where your money is locked away, you're not entirely wrong. An escrow account, sometimes called an impound account, is essentially a savings account managed by your mortgage lender. You deposit money into it with every single mortgage payment, and the lender uses that money to pay your property taxes and homeowners insurance bills on your behalf when they come due. Why do they do this? It's all about risk. Your lender has hundreds of thousands of dollars invested in your home. The two things that could most easily jeopardize that investment are a catastrophic event, like a fire or a tax foreclosure. If you don't pay your homeowner's insurance and the house burns down, their investment is gone. If you don't pay your property taxes, the county can put a lien on your home and eventually seize it, placing their claim ahead of the lender's. The bank could lose everything. So, to protect themselves, most lenders require you to have an escrow account, especially if you put down less than 20%. It's their way of ensuring those critical bills are paid on time every time. It's non-negotiable for them. Think of it as a subscription management service for your home's biggest bills. You pay a predictable amount each month, and you never have to worry about getting hit with a $4,000 property tax bill in November or a $2,000 insurance premium in May. The lender smooths it out for you. So, how do they figure out how much to take at closing to start this account? This is where the math on your closing disclosure can look like a complex algebra problem. But the principle is simple. They need to collect enough money at closing to ensure there will always be enough in the account to pay the bills when they come due, plus a legally allowed cushion. Let's build a real-world example. Imagine your annual property taxes are $6,000, and your annual homeowner's insurance is $2,400. That's a total of $8,400 per year. The lender divides that by 12, which comes out to $700 per month. This $700 will be the escrow portion of your monthly mortgage payment. But they can't just start with a zero balance. What if a big tax bill is due just 2 months after you close? You would have only paid $1,400 into the account, but the bill might be $3,000. To solve this, they seed the account at closing. Here's how they calculate it. The lender looks at the calendar. They know when your tax and insurance bills are due. Let's say you close in January. They know the first half of your property taxes are due in April. By April, you will have made 3 monthly payments for February, March, and April, putting $2,100 into escrow. But the tax bill is $3,000. You're short. So at closing, they will collect enough months' worth of payments to cover that shortfall. On top of that, federal law, specifically the Real Estate Settlement Procedures Act or RESPA, allows them to keep a cushion in your escrow account. This cushion is typically equal to 2 months' worth of escrow payments. In our example, that's another $1,400, $700 times 2. This buffer protects them and you from unexpected increases in your taxes or insurance premiums. So, at closing, you're not just paying 1 month of taxes. You might be paying 3, 4, or even 5 months of property tax and homeowners insurance premiums upfront to create this initial deposit and cushion for your escrow account. It feels like a huge, redundant fee, but you have to remember, this is your money going into your savings account to pay your future bills. You're just required to set it up. Now, this system isn't static. Once a year, your lender will perform what's called an aggregate escrow analysis. It's a fancy term for them auditing the account. They look at what they projected your taxes and insurance would be, and what they actually were. If your property taxes or insurance premiums went up, you'll have a shortage in your account. Let's say your taxes increased by $600 for the year. The lender likely paid that bill for you, creating a $600 deficit. To fix this, they'll do 2 things. First, they will increase your monthly mortgage payment for the next year to account for the new, higher tax bill. Second, they have to make up that $600 shortage. They'll usually spread that shortage over the next 12 months, adding an extra $50 to your payment until it's paid back. This is why people get those dreaded letters saying their mortgage payment is going up, even on a fixed-rate loan. It's almost always because of an escrow shortage. On the flip side, what if your insurance premium went down, or they overestimated your taxes? You'll have a surplus in your account. If the surplus is over a certain amount, usually $50, the lender is required by law to mail you a check for the difference. It's one of the best pieces of mail a homeowner can get. A surprise check from their mortgage company. So the big question is, can you avoid escrow? Sometimes. If you make a large down payment, typically 20% or more, and have an excellent credit profile, some lenders may give you the option to waive escrow. The upside is you have more control over your money. You can keep those funds in a high-yield savings account and earn interest on them yourself until the bills are due. The massive downside is that you are now solely responsible for saving and paying those enormous bills on time. It requires incredible financial discipline. Forgetting to pay your property taxes is not an option. For many people, the forced savings convenience of an escrow account, even if it means the bank holds their money, is well worth the peace of mind. It transforms unpredictable, lump sum expenses into a manageable, predictable part of a monthly budget, which is the entire point of a stable home payment. But this stability, this predictability, doesn't just start with your first monthly payment. It starts at the closing table. And to truly be in control of that moment, you need to understand how all these disparate pieces we've discussed finally come together. We've journeyed through the entire landscape of mortgage fees. We started with the lender's own costs, the origination, underwriting, and processing fees that pay for the service of creating your loan. Then we moved to the essential third-party reports, the appraisal that verifies the home's value, the credit report that checks your history, the flood certification that assesses risk. We navigated the world of title insurance, ensuring your claim to the property is clear and protected. We covered the government's slice of the pie, the recording fees and transfer taxes that make the sale official in the public record. And just now we unpacked the forward-looking costs, the prepaid interest, the homeowner's insurance, and the property tax reserves that seed your escrow account. It's a lot. It can feel like a dizzying list of hands reaching out for a piece of the transaction. But here is the single most important secret to managing all of it, the tool that brings order to the chaos. The law is on your side. Specifically, a rule known as the TILA-RESPA Integrated Disclosure Rule, or TRID. You don't need to remember the name. What you need to remember are the two documents it created to protect you: the loan estimate and the closing disclosure. These are your sword and shield. The loan estimate, or LE, is the document your lender is required to give you within 3 business days of you submitting a loan application. Think of it as the official quote. It lays out, in a standardized format, all the estimated costs of your loan, from the interest rate to every single fee we've talked about. It's the lender's promise, their detailed breakdown of what they expect you to pay. The second document is the closing disclosure, or CD. You must receive this document at least 3 business days before your scheduled closing date. This is the final bill. It's the definitive itemized list of every single dollar and cent involved in your transaction. Your single most powerful action as a homebuyer is to take these 2 documents and compare them, side by side, line by line. Because under the TRID rule, lenders can't just change fees on you at the last minute without a valid reason. The law puts these fees into 3 distinct categories of tolerance, which is just a fancy way of saying how much they're allowed to change between the loan estimate and the final closing disclosure. The first category is zero tolerance. These are fees that cannot increase at all. Not by $1, not by 1 cent. What the lender quotes you on the loan estimate for these specific items is what you must be charged on the closing disclosure. This category includes the fees the lender or mortgage broker controls directly. That means the origination fee, the application fee, the underwriting fee, any charge they keep for themselves. It also includes the cost of any third-party service where the lender requires you to use a specific company they choose. If they tell you, you must use our affiliated appraiser, then that appraisal fee has zero tolerance to change. Finally, this category includes transfer taxes. The amount is set by the government, the lender knows what it is, and it cannot change. If you see an increase in any of these fees on your closing disclosure, you need to raise a red flag immediately. The second category has a 10% cumulative tolerance. This is for fees that have a little bit of wiggle room. This group includes recording fees, which can sometimes have minor variations from the initial estimate. More importantly, it covers the third-party services where the lender gives you a list of approved providers to choose from. For example, your lender might say, "Here are 3 title companies we work with. You can pick any one of them." Or, "Here are 5 surveyors we recommend. You have a choice, but it's from their list." The fees for these services, like the title search, the pest inspection, or the survey, are allowed to change. However, the total sum of all the fees in this 10% category cannot increase by more than 10% from what was on your loan estimate. It's not a 10% limit on each individual fee, but on the group as a whole. So if one fee goes up a little but another goes down, it might balance out. But if the total for this entire bucket of costs is more than 10% higher on your final disclosure, the lender is in violation and typically has to cover the difference. The third and final category is unlimited tolerance, or sometimes called no tolerance. These are costs that can change by any amount without a legal limit, and for good reason. This category includes all the prepaid items we just discussed: prepaid interest, your first year's homeowner's insurance premium, and your initial escrow deposits for property taxes and insurance. Why can these change? Because the lender can't perfectly predict them. The amount of prepaid interest depends on the exact day of the month you close. Your homeowner's insurance premium depends on the policy you choose from the provider you select. The property tax amount might be reassessed by the city between your application and closing. This category also includes any third-party service that you shop for and choose entirely on your own, without using a provider from the lender's recommended list. If you go out and find your own title company, for example, the lender isn't responsible for what they charge, so that fee can change without limit. So what does this all mean for you? It means that in the final days before you get the keys to your new home, you have one last critical piece of homework. When your lender sends you that closing disclosure, do not just glance at the cash to close number at the bottom. Open the loan estimate they sent you weeks or months ago. Put them next to each other on your kitchen table or on your computer screen and start comparing. Go through Section A, the origination charges. Did any of those numbers go up? They shouldn't have. Go through Section B, services you cannot shop for. Did those go up? They shouldn't have. Then look at Section C, services you can shop for. Add up all the costs in this category on your loan estimate, and then add them up on your closing disclosure. Is the final number more than 10% higher? If the answer to any of these questions is yes, you pick up the phone. You call your loan officer, and you ask calmly and confidently, "Can you please explain this discrepancy to me? The origination fee on my closing disclosure is higher than it was on my loan estimate, and my understanding is that this is a zero-tolerance fee. This isn't about being confrontational. This is about being an informed consumer. This is about holding the professionals you hire to the standards the law requires." 99 times out of 100, it's a simple clerical error that can be fixed. But that one time it isn't, that one time it's an illegitimate junk fee that was slipped in at the last minute, you will have saved yourself hundreds or even thousands of dollars. You will have protected yourself. Understanding the world of mortgage fees isn't just an academic exercise. It's about transforming one of the most stressful and confusing processes of modern life into something manageable. It's about shifting the power dynamic. You are no longer just a hopeful applicant, crossing your fingers and hoping for the best. You are an educated partner in the transaction. You understand the value you're paying for, you know your rights, and you have the tools to ensure you are treated fairly. Buying a home is so much more than a financial transaction. It's the foundation for your life, the backdrop for your memories. The journey to get there shouldn't be a nightmare of hidden costs and last-minute surprises. It should be a clear, transparent path. By taking the time to learn this, you haven't just learned about fees. You've learned how to take control of your financial destiny. You've ensured that when you finally sit at that closing table and sign your name on that final page, you're doing it not with anxiety or uncertainty, but with the profound confidence of someone who is truly ready to be a homeowner.